Being like it's 1999. John Steinberg is the president and COO at BuzzFeed, a CNBC contributor. He joins us this morning here at Post 9. John, good morning.
Good morning.
Big piece in the Times over the weekend,
yes,
looking at King specifically.
Yep.
I wouldn't argue with rigorous analysis, but it's getting attention nonetheless.
Well, it got attention because there was an IPO with characters walking around dressed in fruit suits for a company that had highly concentrated revenue. The New York Times puts the strawberry on the cover and says partying like 1999. Not to mention King does $2.6 billion in revenue, has 30% profit margins. So it's a little bit of a stretch and a little bit of a kind of a shtick, I think.
All right. So to what degree is this all true? This echo of the dot-com boom?
I think that if you look at these stocks on a one-year basis, they are all massively up. If you look at the indexes, they're all massively up. There's a modest correction on expensive stocks, but these are real companies with real revenues that are transformative, even King. So I think it's hard to argue that this is a bubble.
Well, one of the examples they pulled out, which resonated, Airbnb,
yes,
given a valuation recently of $10 billion, more than the entire Hyatt hotel chain with no hotel.
I love the venture round when they use that. There's preferences on that investment, so the investors get their money out. So it's not a real $10 billion. The investors get their money out first in a liquidity event. It's called a liquidation preference. I'm sure it's on that deal, so it's not a real $10 billion.
You know, I thought what was notable about King in a way was how modestly it was priced. Now, clearly it did terribly in the aftermarket.
Yep.
And the underwriters have told me, listen, we were well oversubscribed. We could have gone even higher. We didn't expect the market to evaporate the way it did the next day. But we're not talking stratospheric multiples at all here. And as you point out, this company actually does a lot of EBITDA. It may not, because it's perhaps it is, as the critics say, a one-product company, but it may not be.
You know, it's exactly like Facebook. I remember when Facebook was down in the 25s, and everybody said to me, oh, what a terrible company. They don't make money. I was like, what do you mean they don't make money? Crush is the exact same thing. If you took out Candy Crush, the other 5 games still do $125 million. Bookings per quarter. Candy Crush is the problem because it's just one massive outlier. So, yes, there's a whole entire meme going on now that Candy Crush is a terrible company. It's unfair.
What about, there is a point at which industry growth will not support the number of players that are trying to get in or already in, right? That is a danger, right? In cloud, there will be some washout.
Yes. And the other issue with all of these different things is that there's a lot of cloning going on. We talked about cloud storage last week where everybody can compete there as a commodity. There's a new game out today called 2048 that everybody is playing, this block game that's been cloned 50 times. It'll undoubtedly take players away from Candy Crush. So the competition is rampant. And you're right, Carl, there's only so many cloud users and game players.
I think just to move along for the broader market, one of the distinctions that was made, and this is what we've been seeing, the Dow, the major components of the S&P 500, the big companies, are not getting dragged into this valuation craziness. And that is a lot different than 2000, where you saw price-to-earnings multiples in the 50s and the 60s.
Yes, and I will say there's an interest rate issue going on, and I think the interest rate comments from a couple weeks back by Yellen affected this, and everybody is afraid that if you're actually able to earn any kind of return on your money, investors will not be so desperate for any kind of growth in the tech stocks, and that may take down the multiples as well. I think all of these names are up today because the broader market is up, but people also feel like, wow, she's not going to take up rates anytime soon, so I still need to be in these high-growth names.
There is this an argument that is made, though, by some who invest in these public companies that a lot of the growth is taking place during the venture phase, and that once they come public, because they seem to be coming public later in their lives, so to speak, you suddenly are always dealing with declining growth rates,
yes,
as opposed to accelerating growth.
Yes, I think that's right. And I think that when you talk to bankers and you talk to hedge fund investors, so many of them now want to have these private funds that they can get into because they can lock in at being in a company, you know, at $1 billion before it prices at 1.2 or 1.3 billion. But you're right, the spreads are very narrow there. It's also dangerous for the venture investors because if market conditions change a little bit, they're effectively in a public stock, and then they might be subject to a lockup of, 180 days because they're in the private rounds.
Speaking of public stocks and market structure, what are your friends saying about Michael Lewis today?
Well, you know, I haven't talked to any of my friends. I watched it last night with my wife, and I thought to myself, really, is this news? I mean, everybody has known that fiber optics and proximity to the exchanges have always been an influence in being able to trade. So I haven't talked to my friends yet about it, but I'm kind of surprised it's such a big story. I want to read the book, but I feel like it'll be so boring because it's just that one topic that I already know.
Is it enough for someone like Michael Lewis, though, to weigh in to affect change? Because we could talk about it here until we're blue in the face.
I know. It really is a question of how media influences what people think about it. And the fact that the strawberry on the cover, how things are phrased. So Michael Lewis coming out and saying it's rigged, where it's not really rigged, it's if you pay, you have unfair advantages in trading, will undoubtedly bring attention.
Well, remember the effect of Meredith Whitney on 60 Minutes with the muni bond market, how it led to subsequent outflows in the market when everyone else, all the pros in the market, were saying this is incorrect.
Well, look at Amazon.
Psychological impact.
Look at Amazon and drones. I mean, everybody knew that everybody was excited about drones, and then Bezos goes on and shows drone delivery delivery of packages, and then drones. I mean, 60 Minutes, I got to tell you, for a show that really gets to, a very older demographic, it's moving everything these days.
It is still the news show, so to speak, for the nation in many ways, and it does have great influence.
Well,
it's true.
Mark Cuban's going to be on The Half today talking about market structure. Would that ever weigh on your decision to take BuzzFeed public if that were part of the discussion?
No, I don't think so at all. And in fact, I don't know if it was Santelli or who was talking earlier about the fact that, you're talking about a penny here, a penny there. Unless you are a high-frequency trader, being a little bit front-run in high-frequency trading doesn't really impact you. And in anything, I think the Jobs Act has been transformative. There will be some high-quality companies, there will be some low-quality companies, but I think the government has done a good job of allowing a sub-billion-dollar revenue company to do all of the work without being in the public light.
Yeah, sort of a fast track for some of these smaller companies.
Yeah.
John, we'll see you soon.
See you guys
Thanks
soon.
a lot. John.
Thanks, guys.